What's up, everyone? It's Scotty with Money Vesting. So Bridgewater Associates posted a research paper talking about equilibriums in the market and where we are both in the US and over in China. In other words, really talking about the West and the East and where we are in that cycle with both liquidity and, of course, financial assets. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below. There is a 16% annual discount available for 2 more days, so it's available and valid until the end of this month that you can take advantage of and, of course, get access to all the buy and sell alerts, options alerts, trade ideas, including all the private member videos and live streams that we are doing 3 days a week, Monday, Wednesday, Friday, for all the members. So link's going to be down below. So this right here is the research paper. Now that was pretty long. It was about 15, 20 pages. I don't want to bore you guys with all that, but I wanted to go over specific details of what was discussed in that research to really help us understand where their perspective is for 2023, right? What point of view they have on the markets and the economy. So an update from our CIOs, that's Chief Investment Officers, the tightening cycle is now beginning to bite. And they mentioned that the last year's historically large and rapid tightening is starting to constrict the financial system and slow the economy. And this is necessary and will be needed to have a sustained and to restore equilibrium conditions. So moving forward, they mentioned that the tightening cycle that began roughly 1 year ago takes about that long for tightening to have significant economic impacts, and signs are emerging that the effects are now spreading and deepening. So again, there is a bit of a lagging sort of effect with the tightening cycle the Federal Reserve embarked on same time last year. As soon as it started raising rates, we obviously don't see the effects of that right away, but it takes time. There is a lag effect, and damage to the banking system is a manifestation of the tightening and is now likely to be a contributor. Economies rely on the steady flow of liquidity from cash and credit to assets and spending. And this liquidity pipeline runs from the central bank, which is again the Federal Reserve in this case, as the originator, and through the financial system as an intermediary to markets and finally to spending and income. The combination of central bank raising interest rates and draining reserves, with banks experiencing more constrained deposit and capital conditions and now tightening credit standards, is very likely to constrain the flow of money and credit to markets and the economy, with impacts on spending and income. Now, we've already learned that money supply is now finally starting to contract. It is negative 4% on a year-over-year basis in March. That is a pretty significant problem because we have never really seen that in over 90 years. And manifestation of this are now showing up in the data, as we've described in recent research. Stepping back, the most basic problem to recognize is that economies and markets are far from equilibrium conditions. Equilibrium meaning conditions that are normal to a consistently working and functioning economy in the markets. That's what they are talking about. So in brief, we believe that there are 3 major equilibriums and 2 major policy levers that interact to drive markets and economy. Number 1 is spending and output in line with capacity. So, which roughly translates into something like 2% real growth for the GDP, right, after inflation, with 2% inflation and 4 to 5% nominal spending growth consistent with that, and an unemployment rate that's around average 4 to 5%. Now, again, if you do the math, if GDP is growing on a nominal basis 4%, inflation's 2%, real growth is 2%, and nominal spending is also very much in line with productivity of 4 to 5%. So in that economy, in that sort of environment, the economy is at equilibrium because spending and productivity are very much aligned at 4 to 5%. Inflation's at 2%. And of course, unemployment rates around average 4 to 5%. Debt is in line with income growth. So creation of debt or credit is very much in line with the creation of income and wages. And the growth rates are similar, meaning credit growth that's not too high and not too low. So very neutral. And interest rates are acting as neither a major incentive or a disincentive to borrow. Because, of course, when you have interest rates at 0%, that is a big incentive for companies, for individuals to borrow. When you've got interest rates at 5%, that's obviously a big challenge, where it's de-incentivizing people to actually borrow. So very neutral interest rates. And then a normal level of risk premium in assets relative to cash. That is also really important when it comes to financial assets in the functioning of the economy and just, everything being in equilibrium, because bonds need to have a higher attractiveness relative to cash. In other words, bonds provide an expected return above cash, and equities provide an expected return above bonds, right? So that's going to be the chain of financial assets where at the bottom we've got cash, then bonds, then stocks, and that's really what's providing you with the return streams of different financial assets. So if these conditions don't exist, which currently they don't, intolerable circumstances will ensue that will drive changes towards these equilibriums being reached. For example, if the economy's usage of capacity remains low for an extended period of time, that will lead to social and political problems as well as business losses, which will produce further changes until the equilibrium has been reached. So taking a look at why we are now in the bearish disequilibrium, that's where we are right now according to Bridgewater. So we're not at equilibrium. So of course, inflation is not at 2%. Growth is not at substantially high levels of 4 to 5%. Unemployment's a little bit lower than what the average might suggest. And of course, financial assets are completely out of whack because bond premiums with respect to stock premiums and of course earnings yield, and not to mention the cash rates, everything is out of whack right now. So we are in a bearish disequilibrium according to Bridgewater, and the following table summarizes a few key measures for the US economy, which I'll dissect in just a minute. But with respect to the economy, the inflation rate is too high. We all know that. The rate of nominal spending is also too high to bring that down. So nominal spending is actually also high. And as a result, we're not seeing inflation, come down, or is what they're mentioning is going to make it more difficult for inflation to come down. The rate of unemployment is too low to bring wages down. And despite nominal growth being too high, the real growth rate is lower than desired, of course, because of inflation. Of course, a weaker real growth rate is required to resolve all the other imbalances, but that is a form of disequilibrium on its own, illustrating the challenge of having to create one disequilibrium in order to resolve another, and then iterating back and forth as policymakers try to bring all of them in a line. So with respect to the markets, and bond yields are too low. So now we move over to the financial assets away from the economy. So going over to the markets, bond yields are too low in relation to cash, and discounted inflation rates are well below current and projected inflation rates as well. So there is no risk premium in bonds right now, because even with the online savings account, money market funds, the actual rate of return is very much in line, right? So you can go to online savings account, money market funds, they're paying you 4.5, close to 5%. So there is no premium in holding on to bonds at the moment. There's roughly normal risk premium in equities relative to bonds based on the current earnings. So that's really important because earnings expectations are somewhat in 2023, at least they're expected to decline a little bit over 4 to 5%. But future earnings are also not that strong, so to speak, considering the environment that we're in. And that's why the premium in owning equities is also somewhat neutral to slightly better for equities relative to bonds based on the current estimates for earnings and the current bond yield. But if you do get a recession as needed, they mentioned that you do need a recession to bring everything back in line and back in equilibrium. But if you do get a recession as needed to get the desired inflation rate, to bring it back down to 2%, earnings would be about 20% lower, making the earnings yield too low in relation to bonds at the same time as the bond yield is too low in relation to cash. So you follow that chain of thought, right? So if there's a recession because it's needed to bring everything back in equilibrium, back in line, the earnings will be declining by 20% in a recession, and thereby the earnings yield will be lower in relation to bonds, which is already lower in relation to cash. In other words, in order to deal with today's economic disequilibriums, central banks are having to make cash very attractive, which is making bonds and stocks unattractive in relation to cash. And at the same time, nominal spending is too high and the labor markets are too tight to allow for the easing of monetary policy that is priced into the front end of the yield curve, which is the easing that would be necessary to provide for a normal risk premium in bonds. So this right here is what they mentioned for the US economic and market equilibrium checklist and where we are, whether we're in equilibrium, out of equilibrium, or near equilibrium. And this is going to be some economic indicators, and these right here are market indicators. And what you'll notice is unemployment is incredibly low, right? 3.6%. So we are out of equilibrium according to Bridgewater. And the reason for that is because of low unemployment. We are seeing wage inflation still pretty high. And you'll notice that level of activity at potential, we're slacking a little bit. So 1%. So we are near equilibrium, but not in equilibrium. Inflation at target, absolutely not. Inflation is running at over 5%. So we are out of equilibrium on that front. Real growth at potential is at 1.7%. So that's in equilibrium because the expected real growth is around 1 to 2%, preferably 2%. We're closer to that level. So it's going to be in equilibrium. It should really be near equilibrium, but they have labeled it as in equilibrium. And then nominal spending, productivity, so the amount of productivity plus population growth plus 2%. Right now it's at 6.2%, which is out of equilibrium. So nominal spending is just a little way too high with relation to productivity right now. So we've got market pricing equilibrium. So bond yields provides normal risk premium over cash rate. We're at 3.4%, so that is going to be out of equilibrium because it's not higher than the cash rate. Earnings yield provide normal risk premium over bonds. They are in equilibrium for now because the earnings yield is at 5.4%, but this can decline, of course, if the earnings do decline, if there is a recession, to bring basically some of these other things back in equilibrium and back in line with their assessment of the markets and the economy. Inflation is in line with break-even inflation 2.5%, out of equilibrium, and risk yield provides normal risk premiums over the cash rate 1.2, which is near, and discounted tightening easing in line with growth and inflation is out of equilibrium as well. So we do have 6 out of 10 items that are out of equilibrium, only 2 that are in equilibrium. That's actually going to be the real growth because of the nominal spending being too high, and the earnings yield because of the current estimates that can obviously change in the future. Now, they also mentioned that when you add up this picture, you can see why the degree of disequilibrium is so high and why we favor cash in relation to assets in most developed economies until these imbalances are closer to being resolved. On the other hand, we favor assets in relation to cash in Japan, China, and much of Asia because they are either close to equilibrium or are in disequilibriums that favor an expansion of liquidity that makes cash unattractive in relative to assets. So I'm actually going to come back to that. And this basically goes over where we are on the path to equilibrium. But really, this is the liquidity cycle that they talked about in that research paper, where if we do see liquidity tightening, that leads to risk premiums rising and assets also falling. And then the growth basically slows down. You've got central bank, as the growth slows down, you got the central bank kind of easing, taking a foot off the gas, right? So Federal Reserve obviously in those lines expecting a pause and a cut. The market's all, expecting all these cuts in 2023. And that obviously leads to liquidity improving. And then that leads to risk premiums falling and assets once again rising. Think of it as QE and all the money printing again. Growth rises and then central bank once again tightens, and that leads to this liquidity tightening once again. So right now as it stands, what they mentioned is that the US, the UK, and Europe are actually moving to the right, where we are seeing the growth slowing down and risk premiums are rising and assets are falling and liquidity is very, very tight or tightening further. But eventually it's going to move around this curve back to, of course, quantitative easing in the future, right? Of course, depending on how much the economy slows down. And China, Japan, and Asia are actually moving into this quantitative easing environment where liquidity is improving and growth rates are rising for those particular markets. And this is just from an economic standpoint. This is from a market standpoint. And they mentioned that relating to the liquidity cycle to asset returns in the West, which is the US, the UK, and Europe, the coming stage is bad for stocks and less bad for bonds than where we've been. And again, it just, when you are going through a liquidity tightening cycle, growth is slowing down. They mention equities as negative, bonds as positive. That simply means that they're pretty much mentioning that coming stage is bad for stocks and less bad for bonds than where we've been. But again, I would take this with a grain of salt because, we already know Bridgewater Associates is very bullish on China, bullish on, Japan, and bullish on Asia. And there's nothing wrong with being long or, bullish on emerging markets. Like I myself, for example, am bullish on India. I'm invested in Indian stocks, and I do believe that I think India's got a lot of potential in the future. It's an emerging market, growth is there. So there's nothing wrong with that. But, of course, the US is in a whole different sort of game of its own. We've got, lots of things to deal with respect to interest rates, inflation, and the economy, and whether there's going to be a potential recession or not. Every time we do see, a very strong green day or a very strong red day, all the bulls and the bears kind of pop up on the comments once again. What happened to the earnings recession? What happened to the economic recession? Look at stocks rallying here. I would really encourage you to go back and kind of really educate yourself on what market basically is pricing in and why the markets are moving higher in the first place, right? And how these things all have a time lag with when that happens, right? So let me know your thoughts down in the comment section below. I do think there is some analysis, of course, some truth to this research report that suggests that stocks right now could be on a relative basis bad and bonds are less bad because cash rates are so high in the US. And of course, money market funds, we've seen, deposit bases absolutely explode in money market accounts to over $5 trillion because of the higher interest rates that they are yielding. But of course, time will tell if there is going to be an economic recession, and if so, how severe and how much is that going to affect earnings. Earnings recession will already start after the first quarter 23 earnings are all out, because we are going to see that decline on a year-over-year basis, and Q4 was also a decline last year for earnings. So, but that doesn't necessarily mean that's going to be bad for stocks, right? So again, if you have any doubts, just ask. Right? Just simply ask. Just because there's an earnings recession doesn't mean that that's bad for stocks. That's bad for the market. Oftentimes we always kind of think recession as like being bad for stocks. No, an earnings recession can actually be good for stocks too. Why? Because an earnings recession can really stoke that concern among the Federal Reserve members, the Fed itself, that the economy is weakening, and which could obviously lead to an economic recession, which thereby could take the foot off the gas from the Federal Reserve, starting to pause and start potentially even cutting rates, and the markets are forward looking, so they're pricing in potential rate cuts, and that can actually lead to higher gains, more rallies in the market. So just because the earnings are declining doesn't mean that that's going to be bad for stocks. Yes, it makes the market look more expensive because earnings are coming down, and earnings are really the denominator of that P multiple, but it doesn't necessarily mean that it's bad for stocks. So that's something to keep in mind. So hope you guys enjoyed this video. And again, let me know your thoughts down in the comment section below. What do you think about this liquidity cycle and the equilibriums that we are, listening in from Bridgewater Associates? But as always, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below if you're interested in joining us. Of course, getting access to all the binds alerts, options alerts, trade ideas, everything's going to be included. As always, happy investing. I'll see you all in the next video.